Welcome back to Finance Friday. It's another special edition of Money Girl where I answer your burning money questions. Today's topic comes from Christina T., who says, I'm a junior in college and have earned several scholarships and a stipend to pay for school. I've been able to save some of that money and want to open a Roth IRA to jumpstart my future. But I understand you can only have a Roth IRA when you have earned income, and I'm not working. My stipend is taxable income because I receive a 1099 miscellaneous form for tax filing. Would that income allow me to open a Roth IRA? Thank you for this great question, Christina, and congratulations on earning money to pay for college. I love that you're already thinking about your future financial well-being and opening a Roth IRA. You are light years ahead of where I was at your age. So this podcast will review who can contribute to an individual retirement account or IRA based on the types of income you or a spouse receives. Welcome back, everyone. Thanks for joining me on episode 873. I'm Laura Adams, an award-winning author, finance spokesperson, money speaker, founder of the Money Stack, which is a Substack newsletter, and host of the Money Girl podcast with over 43 million downloads. Do us a favor and hit that subscribe button and consider submitting a 5-star rating or review on your podcast app if you're getting value from the free content we love creating here. And if you have a question about money, leave it on our voicemail at 302-364-0308. You can always send me an email and sign up for the free Money Stack newsletter at lauradadams.com. All right, so let's start with a little primer about IRAs. An IRA is an account where you own assets like investments that get preferential tax treatment. An IRA or any retirement account is simply a shelter that protects your assets from taxation while they're inside the account. You might choose a traditional IRA, which allows you to skip paying tax up front on the money that you put in. In other words, your contributions are tax deductible. However, your future withdrawals of contributions and earnings that you take out of the account when you retire will be subject to ordinary income taxes. For 2024, you can contribute an amount equal to your, or if you're married and file a joint tax return, your spouse's qualified income up to $7,000. However, if you're over 50, you can contribute an additional $1,000 or $8,000 total. And I'll address what qualifies as qualified income in a moment. So let's say you're 35 years old, you earn $50,000 yearly, and you file taxes as a single. If you max out your traditional IRA in 2024 by contributing $7,000, you would only pay income tax on $43,000 of income, not on $50,000. So you see, every dollar you contribute to a traditional IRA reduces your taxable income and the tax you owe, which is a really nice benefit. So a traditional IRA allows you to defer paying tax. You don't eliminate it, but you defer it on your contributions and earnings until you make future withdrawals. And you can begin taking penalty-free distributions after the official retirement age of 59 and a half. And you have to start taking required minimum distributions, or RMDs, after age 73, or it will be after age 75, beginning in the year 2033. If you tap a traditional IRA before 59 and a half, in most cases, you'll have to pay income tax on the withdrawal plus an additional 10% early withdrawal penalty. So that's why I never recommend tapping a traditional account early. It's very expensive. One rule to know about traditional IRAs is that if you or a spouse participate in a retirement plan at work, maybe you've got a 401k or a 403b, you can max out a traditional IRA as well. However, some or all of your IRA contributions may not be tax deductible depending on your income. Now, let's flip over to the Roth side and talk about what a Roth IRA is. It's similar to a traditional IRA in many ways, Except how it's taxed. You make after-tax, non-deductible contributions and then get to make tax-free withdrawals in retirement. So using my previous example where you're 35 years old, you're earning $50,000 a year, and you contribute $7,000 to a Roth IRA, in that case, you'd have to pay tax on your total earnings of $50,000. There's no upfront tax benefit of making Roth contributions. However, you'd never have to pay tax on the account again, even if your Roth IRA mushrooms with massive investment growth. So skipping taxes on growth and enjoying tax-free income in retirement is a really big deal, which is why I always recommend having a portion of your portfolio in a Roth. Additionally, there are no RMDs with a Roth IRA as there are with a traditional IRA. Your Roth IRA funds can just stay there, they can stay in the account, and easily get passed along to your heirs if you don't want to spend the account or you die and have money left over. Unlike a traditional IRA, you can only contribute to a Roth IRA when you earn less than an annual threshold, which I'll review in a moment. For 2024, the contribution limit for a Roth IRA is exactly the same as a traditional IRA. It's equal to your or your spouse's qualified income up to $7,000 or $8,000 if you're over age 50. Another significant Roth IRA benefit is that it's less punitive for taking early withdrawals before age 59 and a half. Since you have to pay tax up front on Roth contributions, you can always take them as penalty-free distributions anytime. However, withdrawals of earnings in the account would be subject to taxes plus a 10% penalty if you're younger than 59 and a half. Be aware that Roth IRAs have a rule that you must own the account for 5 years before qualifying to withdraw your earnings penalty-free, no matter your age. Therefore, I recommend opening a Roth IRA sooner rather than later, even if you can only make a small contribution. That ensures you'll never be in a situation where you have to pay tax on the earnings portion of a Roth IRA distribution because you still need to satisfy the 5-year ownership requirement. All right, I mentioned that you can't have a Roth IRA when you earn over an annual threshold. So that limit depends on your tax filing status and your modified adjusted gross income, or MAGI. For 2024, single taxpayers must have a MAGI below $161,000 to qualify for a Roth IRA. Married taxpayers filing a joint tax return must have a household MAGI below $240,000. If you qualify to contribute to a Roth IRA, but let's say, your income goes up and you're ineligible in the future, you can always keep your account indefinitely and enjoy its tax-free growth. However, you can only make new contributions if your income dips below the annual allowable limit. However, I will say if you earn too much to qualify for a Roth IRA, you can make Roth conversions, which I explain in podcast 768 called Too Rich for a Roth IRA, 3 Legal Ways to Have One. So if that's of interest, be sure to go back in the archive and listen to that show. Okay, now that we've reviewed the differences and benefits of traditional and Roth IRAs, let's get back to Christina's question about whether her stipend qualifies her to have one. In general, you can make IRA contributions if you or a spouse receive taxable earnings during the year. I'm going to go through 5 types of income that qualify you to make IRA contributions. Number 1, compensation for work. So your wages, salaries, tips, commissions, and bonuses from employment always qualify you to have an IRA. And if you're not sure how much you made, you can always verify the amount by looking at the W-2 you receive annually and specifically the number that is shown in box 1 of the form. All right, the second type of income you can have is self-employment income. If you're self-employed, the net earnings from your business are taxable earnings that qualify you for an IRA. Number 3 is alimony income. For IRA purposes, compensation includes taxable alimony payments you receive under a divorce decree or a separation agreement that began on or before December 31st, 2018. However, if you got divorced in 2019 or later, you cannot use alimony to qualify for an IRA. Number 4 is non-taxable combat pay. If you were a member of the United States Armed Forces, compensation for an IRA includes any non-taxable combat pay you received. You should see the amount reported in Box 12 of your W-2. And number 5, education benefits. Income like a scholarship, fellowship, or stipend is generally taxable compensation if it gets reported in Box 1 of your W-2. However, starting in 2020, certain payments not reported to you on Form W-2 are treated as taxable compensation for IRA purposes. Like Christina, you should receive a 1099 for those amounts, which get included in your gross income for taxes. So let's say Christina received a taxable stipend of $5,000 for 2024. In that case, she could contribute up to $5,000 in an IRA. But let's say she received $10,000. In that case, she could max out an IRA with a $7,000 contribution because she's under age 50. So let's go through the types of income that does not qualify for an IRA contribution. For the purposes of an IRA, you cannot include earnings and profits from property, such as rental income, interest income, and dividend income. You cannot include pension or annuity income. You can't include deferred compensation. These are payments postponed from a previous year. You can't include income from a partnership that you don't contribute services to. You can't include income from a conservation reserve program, which pays property owners to protect environmentally sensitive land. And you can't include any amounts other than combat pay, as I mentioned, that you exclude from income, such as foreign earned income and housing costs. Christina, I hope this has been helpful and will get you started on contributing to a Roth IRA. Before we go, a quick reminder to subscribe to The Money Stack. That's my weekly Substack newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or support the show as a paid member and get access to live educational events like my Smart Investing Masterclass that's coming up. So if you want to be a participant in my Smart Investing Masterclass, be sure to subscribe to The Money Stack. You'll automatically get your invitation. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we have an amazing team. I want to thank Steve Rickyberg for audio engineering the show. Brandon Gachis is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.